WWDC. Nearly 20% on the year. And then Tesla in a bit of a sales slump. We saw the firing of that one VP yesterday. And then the gains from the robo-taxi debut earlier this week, they pretty much got erased. Tesla, not as bad as it was earlier this year, but it's still down about 20% on the year, Scott.
All right, Steve Kovac, thanks for that. Let's bring in Evercore ISI's Mark Mahaney now for more on this big move in tech. It's good to have you on this record-setting day. It's funny, you have your top picks of Alphabet, Amazon, and Uber. We were just mentioning Meta there, which has had a really great run here. Why isn't that at the top of your list?
Because it just had a really great run. I don't know, Scott. But I look for these DHQs, these dislocated high-quality companies, and actually, one of the Mag 7 stocks that's really underperformed year to date is Google. It's still off 8%, something like that, 8-9%, year to date. And I think there's a really interesting AI play that is underappreciated. There's some major overhangs on Google related to the government and the antitrust case. I get that, and related to ChatGPT. I'm just struck by the opportunity for that sentiment to change. And if it does, the risk reward on this, I think, is extremely strong, extremely positive. And then Amazon would be our number 2 pick. And then Uber would be our number 3 pick. Look, I like Meta. It's sort of a smaller buy for me now, 25, 26 times earnings. I think that multiple's fine. I just think there's a lot of upside to the earnings. So it's just a quality compounder. If you want real alpha in the portfolio, I think Google's a better bet than Meta.
When you go to Google, though, some stocks underperform for a reason, right? Your ifs, there are a lot of ifs there, right? AI disruption, the DOJ, the lack of cost focus. How much of that do they have to get right so that your ifs aren't too much of a worry?
Yeah, I know I laid out those 3 in a recent report. I actually think the company's done a better job of managing expenses, and I think actually they've gotten more credit from investors for that. So it's really the other 2. I think we're going to get a clearing event in August. I mean, I'm doing my best. We're doing our best to try to predict what Judge Mehta is going to decide. And I don't think the worst case scenario is going to come to pass. The worst case scenario would be a forced sale of Chrome and then a banning on all search distribution payments. I don't think that's going to happen. If it doesn't happen, I think you've got a clearing event for Google shares. And then what Google then needs to do is prove that they can monetize AI searches, Gen AI searches, AI overview searches just as well as they can traditional searches. They've been saying that publicly, but they got to kind of show it in the numbers. How do you do that? You maintain this kind of 11 to 15% search revenue growth that they've done for the last 2 years. You keep that up at the same pace, Scott, and I think the bears are going to kind of lose steam, and you get a real chance for a re-rating here. It's trading at 17 times earnings. I mean, you remove these 2 overhangs, this thing doesn't stop at 18, 19. It goes to 20 to 23 to 25 times earnings, up where Meta is. That's why the stock, I think the setup here is so attractive for Google here. I get the overhangs, but I think they could be removed as early as a month from now in the case of the DOJ case.
Wow. I mean, I thought it was interesting within the last, week or so when Coatue management, and I've referenced this a couple of times on the various programs here, excluded Google from its top 40 tech companies, when they're looking ahead to the next big things for the next, handful of years, it left it off that list. It was the only one of the biggies left off that list. And here's one of the most astute technology investors that we've known. Did you notice that? And was that a statement of some sorts in your mind as well?
No, I have huge respect for Coatue. I just... I'll stick with my thesis on Google. I think that the idea that they've been kind of left behind by Gen AI is massively overstated. I think they've been, 10 years into AI, and now it's the matter of getting that fire lit where it needed to get lit for Google, and I think it has. And I think they've been accelerating their pace of product rollouts. As long as you can get search, you can prove to people that search is going to continue with that growth. Then you get these amplifier effects that I really like on the stock. YouTube continues to gain share amongst all streaming assets. I think Google Cloud is going to show acceleration in the back half of the year. And then you've got this wonderful option value with Waymo that is going to get unlocked. And, if it gets any sort of credit like Tesla does, that just adds to the kind of the multiple re-rating potential for Google. So that's my Google's thesis, Scott. I'm going to stick with it. I look for these DHQs, these dislocated high-quality companies. Google's at the top of my list right now.
Yeah, well, I mean, Amazon is too, right? I mean, it's your number 1 large cap long. And they have their own huge AI aspirations with AWS, as we learned when we spoke to the CEO exclusively a couple of weeks ago out in San Francisco. I mean, they don't want to cede any ground to anybody.
So, yeah, just to line it up right, Google's the number one pick. Amazon's the number two pick. For us, Amazon, there's kind of two overhangs on Amazon. Why it's trading at 28 times earnings versus comps like Walmart that are trading 10 turns higher in terms of the multiple. You know, with Amazon, they got to prove that they can get through these tariff issues, and they may not be able to. But I think they're just as well positioned and probably better positioned than any company out there, maybe with the exception of Walmart. But those two, I think their supply networks are sophisticated enough. I think they've been diversifying away from trouble markets for quite some time. So I'm less worried about them on that side. Bigger concern really is, can AWS show this reacceleration that investors want to see? Microsoft Azure has done a wonderful job in the last 6 to 12 months showing that they're riding the Gen AI wave. AWS needs to show this too. I think they'll be able to do that in the back half of the year. If I'm right on that, you get a re-rating on Amazon to do well.
Had a big debate on halftime today over the next 6 months, which stock was going to do better, Tesla or Uber. Uber's in your universe, Tesla isn't. And in the first 6 months of this year, it's been no contest, obviously. Uber has far outpaced Tesla. What happens if Tesla gets autonomous right? Is that stock, what does that mean for Uber in the race for autonomous?
That'll be a negative catalyst for Uber. What Uber needs, in order for Uber to work from here, they need to get more Austins. They need to get more Atlantas. It's not just rolling out with Waymo, although they've been pretty darn successful with the two rollouts, and that's what's caused the unlock in the stock year to date. But if you get more of these rollouts with Waymo and you get other AV companies, there's more than just, it's not just Waymo's world and it's not just Tesla's world. And by the way, of those two, Waymo is dramatically better in terms of what they've been able to show and roll out so far. But if you get Zoosk in the market and then you get a couple of Chinese players, not in the US, but in parts of the Middle East, maybe in Europe, and if you get more companies like Mobileye, MobileWave, if you get these companies out there showing that you can get multiple AV vendors, maybe not 2 or 3, but maybe 4, 5, or 6, that's better for Uber's economics, better for it as a supply aggregator, because it is far and away the biggest demand aggregator. That's just on the mobility part of the business. On the don't forget the delivery side of the business, which is the world's largest delivery company. So I just think the business is a lot more insulated than people fear, and I think that we're starting to remove these kind of robo-taxi roadkill overhangs. I think there's a lot more room for Uber stock. I know it's up 50% year to date, but this thing trades at like 18, 19 times free cash flow. It should trade at 25 times free cash flow. They're growing their free cash flow 25 to 30%. I think as you get more of these Austins, you're going to see that re-rating continue. So despite how much it's risen year to date, I'll stick with Uber. It's our number 3 pick.
All right, we'll leave it there. Mark, thanks. Good weekend to you. We'll see you soon. Now let's get to our panel. JP Morgan's Mira Pandit and CNBC contributor Neuberger Berman, Shannon Sakosha. It's great to have you both with us. Mira, you first. You heard Ed Yardeni as we talk about the market, which has given back a lot of what it had earlier on this trade headline that Megan brought us earlier. He wasn't too concerned. Ed wasn't. Are you?
Look, we're seeing some of those market jitters come back as soon as you see the first trade headline, and the market environment has felt eerily like the lead up to April 2nd. Now, I would not expect that in this lead up to July 8 or 9 that we're going to see the same outcome this time again. But we do want to be a little bit cautious that trade is not in the rear view. It's still in front of us. But I would say, look, the path of least resistance for this market is higher, given the fact that fear is not an investment strategy. We know that there will be impacts to tariffs to the economy and profits, and yet right now the economy and profits are still holding in months after the initial tariff announcements. And so we do need to keep that in mind, that their strength has been there. And when we think about where the risks lie, we need to be balanced, because right now there are some downside risks, there are some upside risks, and we don't want to miss out on potential upside.
Shan, how do you see it? How do you see it, given that the market does look a little bit different than it did earlier today, and if nothing else, it's just a reminder of what's still out there?
Yeah, and it seems like we always get these announcements on Friday, doesn't it, Scott? So I think one of the challenges is that, what we're really watching for, and really the tariff impact that's most notable is going to be that bleed through to CPI, PPI, and CPI. And we haven't seen that yet. But we have seen tariff revenue increasing. I mean, it's up $60 billion year over last year in a year-to-date period. And so you are going to see either companies digesting some of that or spreading that out or potentially passing that on to consumers. And so over the course of the next couple of months, we're going to get those CPI numbers. I think most notably, though, Scott, everyone's really looking at what's happening with this tax bill because there are aspects of that tax bill that are expected to be stimulative. And so perhaps there's a little bit of look through some of this tariff noise today and into the next week or so, and perhaps past that tariff deadline as we look to see what the implementation of that tax bill is supposed to be and potentially catalyzing some more of that real deregulation that we were expecting would be coming into play around this time.
I see earnings, which are pretty soon, kicked off with the banks in the next couple of weeks or so.
Overall, consensus expectations have remained high. We're still at 9% earnings growth for the year, and that feels a little bit high. I would have said a couple of weeks and months ago that that's way too high. Now I think we're probably in the realm of expecting mid-single digits for the year, so perhaps expectations need to come down a little bit, but not all that much. And it will be interesting to see the pass-through to the consumer. To the point about CPI, how much are companies absorbing this? How much are they looking to pass things on? That's my key question for earnings season. And you see that reflected in a lot of the consumer names right now, that there is some fear around demand. And there is some fear around those upper income spenders, maybe perhaps not being able to post the same results that they had. You've seen some of the weaker consumer spending and retail sales data. So that's the area I'd like to focus on most as we come into this earnings season. Second to that is it another year of Mag 7 outperformance when it comes to profits? Because coming out of last earnings season, you saw some upward revisions there, whereas you saw some downward revisions to the rest of the market. So is that an area that does end up carrying us again?
Shannon, what about what Ed was talking about? All else fails, you got the Fed. You still have the Fed put. And if things go wrong, the Fed's going to come in and cut rates, and that's going to be a positive no matter what anyway.
Right, and I think you have a number of different areas of the market that would potentially benefit from that. Now, the challenge always is that if you're looking at
do you agree with that?
If you're looking at the Fed, no, not necessarily. Because if you're looking for the Fed to come in and save the day, they're coming in and saving the day because of economic deterioration. This Fed is loath to act too quickly. And so they would only act, and they would only act aggressively, doing probably more than three cuts if they felt that there was an issue with the labor market. So I think that there is a put in place. However, I do think there would be some offsets to the enthusiasm around rate cuts because it would indicate that some of this demand has truly been destructed and that we're seeing that flow through to the labor market.
Yeah, but I mean, almost any time the Fed theoretically comes in to cut rates, it's because of some reason behind it. They don't say don't fight the Fed for no reason. I mean, in 08, I'm not equating this to then, but 08, 09, they cut rates. The market went up. In COVID, they cut rates. The market went up. They're cutting rates now. People think that why fight it now?
Well, I think that the Fed also would acknowledge, Scott, that they might be just a bit too restrictive right now. So we're in a little bit of a different dynamic because the Fed already started to cut rates and then they got a bit skittish based on tariffs and then they pulled back. And so, again, we're at a little bit of a different inflection point. I think, again, though, I think if you're looking at the Fed to catalyze additional gains in the equity market, we're probably going to need a little bit more than that based on where we are from a valuation perspective and based on the expectation that growth is going to continue to accelerate.
How do you see that, Mira? I mean, is the Fed coming in just an unequivocal positive, or is it more nuanced than that?
2 cuts might be bullish. Anything more than that might be bearish. Because, again, if they're seeing some weakness in the labor market that forces them to cut more than they originally anticipated, that's going to signal something negative to the markets, especially because what they've been saying essentially since December is 2 cuts this year, and yet those individual dots of the individual participants have migrated higher. So all of a sudden to do a round turn relative to their expectations might have the markets a little bit nervous.
Yeah, I wouldn't disagree with that. I wasn't even thinking about more than 2. Let's just get to 2 and see what happens. Mira, thanks. Shannon, thanks. Good weekend to you both. And we'll see you soon. We're just getting started here. Up next, momentum names helping move the market higher. We talked about the MTUM hitting a record high today. We'll talk about the names within it that are driving the action. We're live at the New York Stock Exchange. You're watching Closing Bell on CNBC. All right, welcome back. Momentum, that factor in those names getting a big boost today. Pippa Stevens is here with more. Pippa, tell us.
That's right, Scott. So momentum stocks are powering the market higher, with the MTUM hitting a new record today. It's now up 17% on the quarter, tracking for its 6th positive quarter in the last 7. Now, since the April low, Robinhood and Roblox have been the top performers, with shares doubling. NRG, Vistra, and GE Vernova rounding out the top 5. And those power stocks are in the green again today, with President Trump reportedly planning executive orders to boost energy supply to power artificial intelligence. That's according to Reuters, which said that the orders would include making it easier for power generation to connect to the grid. Now, that is a major bottleneck for the industry, with some grid operators having a years-long backup for new projects to enter operation. Now, GE Vernova and NRG both hitting record highs today, and then grid infrastructure names like Schneider Electric, ABB, Hitachi, Siemens, and Eaton are also all in the green. Scott?
Yeah, been one of the big themes of this year. Pippa, thank you. Pippa Stevens up next. 314's Warren Pies. He breaks out his second half playbook for us, where he sees stocks heading now from here. He'll tell us next. Welcome back with stocks at record highs. What is the best way to play the markets into the second half? Let's ask 314 Research's Warren Pies. It's good to see you. What's the first thing that comes to your mind? I mean, I feel like the market doesn't have a care in the world until it does, but today, even with a little bit of a pullback off of a trade headline from the White House, doesn't seem to be doing all that much.
Yeah, thank you for having me. I mean, it's easy to say that on a day like this, but we've built quite a wall of worry, I think. So we've been telling our clients to stay bullish. We look out at the second half, and I think the first half was really defined by a bunch of events. And 1 week we're thinking about tariffs, the next week we're thinking about going to war with Iran potentially, and it's really, I think, created this wall of worry, all these events. But when we zoom out and look at the market and think and ask ourselves, where have we come from the beginning of the year? We've basically consolidated. When you take all that stuff away for a minute, forward earnings are at an all-time high, which is unequivocally positive for the market. And what we've had is a sentiment reset. So we came into the year with the 6,800 target on the S&P 500. Our big concern was sentiment. We thought we needed a 10% correction in the first half to reset sentiment. And we see that now. Strategists have dialed down their targets, and I think we're clear sailing, at least as much as you can be in these markets for the second half.
Are better earnings than expected? Is that what at the end of the day will define the second half in the market? And in some respects, it has to, correct?
Yeah, I mean, I think that's the bet, right? We've brought estimates down a bit. I think there's some concern around tariffs and how those tariffs flow into earnings, and I think it's actually given us, oddly enough, kind of a lower bar for the S&P to jump over. So, yeah, I think earnings should be okay. I mean, our concern, our biggest risk, and we listed all the risks in our H2 outlook for clients, is really the economy, which obviously indirectly you're not going to grow earnings if the economy falls into recession. And so that's where we're focusing most of our attention. But for now, I think we're in the same kind of muddle through soft landing environment, and I think S&P earnings are going to surprise to the upside.
So what does the playbook look like then, if we believe what you say and it actually comes to fruition? Where do I get the most out of that?
Yeah, I mean, I think we're going to stick with high quality stocks. So one of the things that we've noticed, if you're going to pick nits in the market right now, breadth is kind of weak. So we've got the market at an all-time high. The median stock within the market is still like 13% off a 52-week high. We did a bunch of analysis on that. That's odd historically. But what we found is that that's really happened a number of times in this bull market, because we have this mega cap led bull market. So if we're going to advance to this, like another 10% in the second half or something like that, you've got to get participation outside of just this very narrow mega cap world. And I don't think, I'm not talking small caps or mid caps. I'm just saying within the S&P 500. So I like high quality still. I think we're going to broaden out a little bit. Still going to be mega cap led. I think I do think oil is going to be weak in the second half. That should be a tailwind in the market, but you want to stay away from some cyclical commodity producing stocks. And I think bonds are going to be okay. I think that the consensus was so concerned about bonds coming into the year. And this is something you and I have talked about over the months. Mm-hmm. And our view is that rates were going to fall. And so I think that's a kind of a nice mix for assets in general. Don't go crazy getting low on the quality spectrum, though.
But it's interesting because people are doing just that. And whether it's you or others who consistently come on the network and say high quality, stick to the better, the biggest. If you look at the high beta stocks, the high beta ETF, for example, and lower quality names, they're doing incredibly well. What's the message or the risk in that?
Well, a part of that is normal off of a market low. Beta is like the number one factor when you make, and we put in a pretty significant low. When we look back at this, when it was a fast rebound, but we were down almost 20%, basically a bear market. So, traditionally, as much as it feels weird, traditionally, this is what you would expect to see high beta lead. I think the next stage of the bull market kind of by definition has to broaden away from that group, though. And so if you ask me how to rotate your portfolio, I think some of these underperforming quality names that have been kind of forgotten about in this crazy speculative run, that's where we're going to get the most bang for our buck, the best risk adjusted second half return.
Because some say it's classic late cycle FOMO moment when you see that performance from lower quality, higher beta.
Yeah, I mean, to me, I would push back against that a little bit. When we study cycles and factor performance, actually low quality leads off market lows, and we had a market low. I think this is part of that wall of worries that you have a pretty big consensus that doesn't recognize the event that we just went through. We went through a real important clearing event where we came in over optimistic. Maybe some of the, I think more of what we saw around the peak in November, where we had small caps, people were trying to buy small caps and stuff like that after the election. That looked like toppy behavior to me. And now what we've had is a washout, and no one wants to believe what's happening. But in fact, I think this high beta leadership is a little bit like what you'd see off of a major market low. And so that tells me that we're still, as crazy as it sounds, like maybe in mid innings for this ongoing bull market.
Wow. All right. We'll leave it there. Warren, thanks. We'll see you soon. Warren Pies. Coming up next, we track the biggest movers into this Friday close. Kate Rogers is standing by with that. Hi, Kate.
Hi, Scott. One group of stocks sitting out today's rally and a retailer upgraded after a turnaround this year. We'll have more after the break.
Insurance.
We're less than 15 from the bell. Back to Kate Rogers now for the stocks that she's watching. Tell us what you see.
Hi again, Scott. So crypto stocks have been a laggard in today's rally. Coinbase, the worst performer on the S&P today after Bitcoin also fell today. Trading platforms Robinhood and eToro will also lower. MicroStrategy, though, bucking that trend. The Bitcoin proxy slightly higher on the day. Crypto stocks are still largely higher for the month. And meantime, SA Lauder is moving higher after HSBC upgraded it to buy from hold and increased its price target to 99 from 80. HSBC seeing earnings per share doubling by June of 2027, citing cost-cutting efforts. They also cited a weaker dollar as benefiting the company because it exports some of its products from the U.S. Shares have struggled over the last year, though, down around 28%, but they are off their recent bottom. HSBC says that rebound seems, quote, credible. Scott, back over to you.
Kate Rogers, thank you very much. Coming up, one firm turning cautious on Uber and Lyft. We'll tell you who and why. Plus, don't miss an exclusive interview with Amazon CEO Andy Jassy. That is Monday. It is 6 o'clock Eastern Time. It is on Mad Money. And we are back on the bell right after this. Coming up next, Nike shares surging today after reporting earnings. What is it signaling for the rest of the retail sector? We'll tell you when Closing Bell returns. That and much more in the Market Zone. to the Closing Bell Market Zone. CNBC senior markets commentator Mike Santoli is here to break down the crucial moments of the trading day. Plus, Gabrielle Fonrouge on the surge in Nike shares today. And Canaccord turning cautious on Uber and Lyft. Deirdre Bose is going to bring us those details. But, Mike, so we're following trade headlines. We have the Treasury Secretary coming up. And maybe the market's following both of those things because we're still above closing record highs for both the NASDAQ and the S&P 500.
We are. Just a real intraday shakeout from those headlines about, maybe re-escalation on the China trade story, which I don't know that it changes the overall atmospherics of what's going on with the market making a run at these highs. What it does suggest, though, as we've been saying for a while, is we've gone from pricing in worst case scenario 10, 11 weeks ago to now pricing in generally better conditions, which are substantiated by the fundamentals for the most part, but also assuming some further progress on trade, or that's not going to be the thing that starts to re-escalate. You don't want to have the sense out there that the market has kind of gotten so far away from the perceived Trump put on trade that it's vulnerable. But right now, it looks like it's going to confirm finally this new high 4 months after the fact.
I'll come right back to you. Looking at Nike there on the right side of your screen, better than 15%. Gabrielle, what's happening here?
Yeah, shares of Nike are soaring today after it reported better than feared Q4 results. Even though sales were down, investors got the clarity they were looking for from CEO Elliott Hill. On a call with analysts, he assured investors that the largest financial impact from his turnaround plan is now in the rearview mirror. He said declines in both profits and sales will now start to moderate. He also shared promising details about new product launches and its move back into wholesalers. Now, this is definitely a turning point for Nike, but don't call it a comeback just yet. Sales and profits will still be down through the first half of fiscal 2026, and it's unclear when Nike can get back to growth. When asked about it on the call, Hill didn't share a timeline. He said the company is going to take it 90 days at a time, and it believes a full recovery will take time. Guys?
All right, still a prove-it story. Gabrielle, thank you. How about Uber and Lyft, Dee? What is Canaccord saying today?
Well, they're under pressure today after a downgrade from Canaccord. As you alluded to, the firm cut its rating on the stocks, both stocks to hold, warning that the rise of robotaxis could rapidly erode their business models. Tesla's software-first strategy, they say, could drive ride costs below $1 a mile compared to what Uber and Lyft are getting right now, which is $3 plus. And Scott, here's a twist that brings me back to the mid-2010s. Uber is reportedly in talks with its former CEO, Travis Kalanick, to help him fund a new autonomous vehicle deal. That is the same Kalanick over at Uber 1.0, who said robotaxis were existential to its future. And of course, he was ousted back in 2017.
Dee, thank you, Deirdre Bose, on those two stocks today. You know what's interesting, too, Mike, is that this has been both a high-quality and, in some respects, a low-quality move to new highs. What do you make of that?
It's fascinating. I mean, there has been this sort of parallel tracks the market has traveled for a while. It was also the case in the fourth quarter. One of the issues is high quality in this current market, the way this index is constructed, has tremendous overlap with the hottest technology themes that you'd want to play. So, yeah, NVIDIA's high quality. It's got 50% profit margins, okay? It has massive free cash flow, and therefore it qualifies in that regard. But it's still adjacent to all those stocks that are just running because they're part of having high leverage to those trades. Also, because of the speed of the comeback off the low, I heard what Warren Pies was saying, where you do generally have this sort of pendulum effect of the stuff that was lowest quality beaten down, the most leverage, does snap back the most. So I think that, you can go along that way for a little while. It hasn't really penalized an investor to stay with high quality for a while. A lot of times in an exuberant market, it feels like you fall behind if you are owning just quality, but it's not the same as defensive. It's not the same as low volatility necessarily either. So all of these distinctions, are out there, and it's fascinating. We're going to close at the high, right? So we're above 61.70. We're, less than 1% from where we were at the peak in February. Since then, earnings are higher, oil, dollar, and yields are lower, and you're closer to a Fed rate cut than you were then, whenever we eventually get one. So all of that bundled together suggests that the market has, a decent base on it in terms of why we're here. The question from here on out is, are second quarter earnings estimates too low at 5% annual growth? Probably. And will the market reward that? Obviously, everything else in the mix in terms of trade re-escalation or deals or whatever we're going to have, I think could create an excuse for the market to cool off and back off, because we are getting overbought again.
Yeah, a week away from the 4th of July holiday, obviously, whether they get the tax bill to the finish line before that.
There is a lot of
serious questions about that.
The seasonal factors, July in general has been positive, especially for the NASDAQ, but we also just had an unusually strong April and May. So who knows if that's been pulled forward or if you can count on
Didn't
that.
we just have like the last 10 Julys have been
they've been
positive?
up.
Yeah, they've been up. Jeff DeGraff was pointing to
Although
that.
mid-July last year was a bit of a peak, so keep an eye on it.
All right, new closing highs for the S&P 500 and the NASDAQ from that kind of record-setting day here. And that's how the bell takes you into the weekend. The Treasury Secretary coming up in overtime.
Well, that's the end of regulation. New York Life Investments ringing the closing bell at the New York Stock Exchange. FTSE Russell doing the honors at the NASDAQ. It was a record day on Wall Street. The S&P 500 and the NASDAQ both hitting new intraday highs and now closing at new record highs. But they did pull back midday after the president said he would end all trade talks with Canada. It was the first record for the S&P since February. It was the first all-time high for the NASDAQ composite since December. The Dow, though, sitting out this new high party. Industrials and staples were your winners. Today, while energy lagged for the week, tech was the standout. That rallied nearly 5%. Some of your movers today, Nike. That was the S&P leader on the back of better than expected earnings and guidance. ARM in the green again today. That was up 13% this week. Circle, another big decline. It's now off 25% in 5 days, but still so high off of those IPO levels just a couple of weeks ago. And some of the recent high flyers, Enphase, Coinbase, and Palantir, all among the worst S&P performers today. Well, that's the scorecard on Wall Street. Welcome to Closing Bell Overtime. I'm Morgan Brennan. John Fort is off today. Coming up on Overtime, wow, do we have a big hour for you. Treasury Secretary Scott Bessent is joining me in just a couple of minutes. President Trump announcing he is calling off trade talks with Canada. We're going to ask about that and many other trade topics, plus his name being floated in the Fed chair sweepstakes. There's a lot to get to there. But that trade news killing the market's highs, closing well off this morning's records. Let's bring in Mike Santoli for more on today's market action. I mean, other than the Russell 2000, though, Mike, we still closed in the green. We're still higher on the week. Stocks still continue to mount this wall of worry. What's the takeaway?
Yeah, there was a final burst higher in the big cap indexes that did leave us not really terribly far off the day's highs. We are still working off this reservoir of anxiety that built up and got very deep around the time of those early April tariff panic lows. I still think you can make the case that large institutional investors have not really caught the move. They probably are better to be buying and adding exposure than selling it. And as I was just mentioning, you come to this place where you've round tripped in about 4+ months in the S&P 500. Earnings forecasts are higher than they were then. Yields are lower. The Fed's closer to cutting rates. All these things that would kind of create the ingredients for substantiating where the market is have cooperated. There was that intraday wobble, though, which did show a sensitivity to any sign that frictions are rebuilding on the trade front with the headlines with Canada. So you have to be aware that at this level, we've definitely priced in some level of trade peace. We'll see if we get it.
Okay. How closely are you watching bond yields in this market, especially since we got a PCE reading that shows that the pace of inflation is still relatively benign, but it did tick up ever so slightly with PCE?
I think yields are kind of giving investors permission just not to worry that much or focus that much about them right now, because 4.25% on the 10-year, it's right in the zone it's been in for 2 years. It's not necessarily kind of forcing you to either believe that it's going to be too high for what the economy to handle, or it's so low that it's telling us something scary about the economy. So you want to watch it. You want to make sure maybe they stay in the range. Clearly, the yield curve has been steepening as lower, shorter-term yields come in as the market starts to price in perhaps more Fed rate cuts before too long. But I think in general, it's a supportive picture. I would point out financial stocks have resumed some leadership recently here, and that's probably related to all that.
And of course, in just about 30 minutes, we will get those Fed stress test results for the banks, and we'll bring those breaking headlines as we get them in real time. Mike, the other thing that stands out to me here is we're at the end of the second quarter. Ryan Dietrich on CNBC this morning said the S&P 500 has gained in July 10 years in a row. One more, it ties the longest win streak ever. Seasonality, how does that factor in?
Yeah, it's net positive if it adheres to it. I do think we have to maybe throw an asterisk in there. I mean, we came off of some of the worst 2-month returns in February, March, and then you have two of the best April, May months ever. Right, you're up huge this quarter because of that. So I don't know how much it's going to bear on the typical seasonal patterns. Last year, I'll also note, July was net positive. We were up a little more than 1% in the S&P, but in the middle of that month, we had a pretty significant peak, and you went on to have a correction through August and beyond.
Okay, Mike Santoli, thank you. Good market wrap there. We'll see a little bit later in the hour. Let's turn back to those trade headlines now. President Trump saying the U.S. is, quote, immediately terminating all discussions on trade with Canada. In a surprise announcement, the president citing what he called the egregious digital services tax. Joining us now to discuss is Treasury Secretary Scott Bessent. Mr. Secretary, it's great to have you on Overtime. Welcome.
Morgan, good afternoon.
Let's start right there. What happened with Canada?
Well, we knew it was coming. We hoped they wouldn't do it. Canada has this digital services tax, and several other countries do too. We disagree, and we think that they discriminate against U.S. companies. But what Canada did here, as of Monday, they're going to implement a retroactive tax. And we think that we don't like the taxes, and obviously we think it's patently unfair to do it retroactive. This was something from the Trudeau years, so we were hoping as a sign of goodwill that the new Carney administration would at least put a break on that during the trade talks. They seem not to have. President Trump has responded, and my inclination is that Ambassador Greer over at USTR will be starting a 301 investigation into the digital services taxes to determine the amount of harm to the U.S. companies and the U.S. economy in general.
Why is a Section 301 investigation the way to go, and what could that outcome potentially yield? Would that be broad-based, looking at Canada and the possibility of tariffs, or very targeted on certain industries?
Well, no, the president can impose tariffs based on IEPA, which is an Emergency Economic Powers Act. The 301 is more durable and could last longer.
So in terms of 301 being more durable and lasting longer, would this be more broad-based, looking across trade of goods and services with Canada more broadly, or would it be more targeted to certain industries?
No, it would be targeted across tariffs on Canadian products. And, again, we'll have to see. We know the amount. I think it's about $2 billion of retroactive digital taxes, which seem patently unfair. We had been talking to the administration in Ottawa about this, and they decided to go ahead with it.
The European Union is doing something very similar in terms of a digital services tax. How is that factoring into negotiations there?
Well, no, that's not right. The European Union does not have a digital service tax. Several countries within the European Union have digital service taxes. None of them have done those retroactively, and we're in active discussions with them to take those down. Because again, who has the great internet companies of the world? It's the United States of America. So it singles out our great American companies.
So Canada, possible escalation depending on how this plays out over coming days. De-escalation, though, and that was the news of the morning with China. What are the details of this China trade agreement?
Well, it's a continuation of the Geneva Agreement, and the centerpiece of it is that we agreed, and it's away from the tariff measures because the tariffs came down immediately after Geneva. Post-Geneva, we had an agreement with the Chinese government to start the flow of rare earth magnets again. They were not as forthcoming as we had hoped that they would be, so the U.S. implemented non-tariff countermeasures against the Chinese government. We believe that the rare earth magnets are starting to flow again under a licensing agreement or a licensing regime that the Chinese government implemented on April 4th. And when we are certain that the magnets are flowing again, we will drop our countermeasures.
So a lot of speculation out there about whether this July 9th deadline for trade deals is a hard line or whether there's some flexibility. Is there flexibility?
Again, it's going to be up to President Trump. We're going to follow his lead. What I would think is going to happen is there will be a lot of smaller trading partners. We will just send them letters. There will be a group of deals that we will land before July 9th on or about. And as Secretary Lutnick said yesterday, he believes there are 10 or 12 of those. And then there are probably another 20 countries where they could go back to the reciprocal tariff of April 2nd as we work on the deal, or if we think that they are negotiating in good faith, then they could stay at the 10% baseline. So there are a lot of moving pieces here. A lot of it is based on the consistency of the negotiations. And again, it will all be up to President Trump.
Historically, trade deals have taken years sometimes to craft. It's incredible how quickly you're moving here when you're talking about 10 waiting in the wings and perhaps another 20 behind that here in the next couple of weeks, just to put it in context. Another thing that seems to be poised to move quickly here, at least in the next couple of days, is the Republicans have reached a tentative deal regarding the state and local tax deduction, SALT. At least that's what we're hearing. That had been a sticking point. My colleague Emily Wilkins is reporting there are a few other key topics still being worked out. But can this big, beautiful bill make it to the president's desk by July 4th?
I think there's a very good chance, and the only way to get there is for the Senate to start voting this weekend. I think I was just with the Senate Republicans, and I think they're going to start voting tomorrow.
Do you see potential roadblocks here over the next week?
Look, nothing's done until it's done, but President Trump's leadership has gotten us here at what people thought would not be a possible date. Leader Thune, Speaker Johnson have done an incredible job of holding small majorities together and getting the bill moving forward. So I'm optimistic we could have a July 4th signing.
What does the bond market need to understand about this bill, what it's going to mean for government spending and the debt load?
Again, it is the largest cut in discretionary spending non-discretionary spending in history. And the other thing too is, what do we care about? We care about growth, we care about spending. So if we can stabilize the spending and up the rate of growth, then that's how we start stabilizing the debt to GDP, this terrible situation we had, the deficit to GDP, 6.7%. We'd never seen anything like this when we weren't at war or in a recession. So, this was a peacetime deficit. So we are going to slowly bring that down in a methodical way, and we will stabilize the debt to GDP level and start bending the curve down.
Interest rates are still elevated, even as the dollar continues to weaken against other major currencies. Do these market moves concern you?
Which market moves?
What we're seeing in the dollar as it weakens and the fact that interest rates are still elevated here.
The couple of things are, Morgan, is I'm not sure why it would concern me that it's natural for currencies to move around. I've traded currencies 35, 40 years. So, currencies move up and down. The U.S. still has a strong dollar policy, and we're putting the economic factors in place to continue that. On the other hand, we are seeing for the first time a real attempt at defense spending in Europe. We're seeing the Germans take off the debt brake. So, more fiscal spend would tell you that the euro should appreciate.
If we stick with rates, and particularly here in the U.S., the Fed was slow to respond to spiking inflation a couple of years ago. We know the president's been very vocal in criticizing the Fed chair. Is it the president's concern that the Fed is behind the curve again?
Well, not my words, but the president's. He calls Chair Powell too late Jay, and so he's obviously worried that the Fed's behind the curve again. And Morgan, I would just point out that studies have shown that people who fall down then tend to look at their feet, which makes them fall down more. And the Federal Reserve fell down on the American people in 2022, let the great inflation get away from them. They should have been hiking sooner. So maybe that's what we're seeing here.
There's a lot of market chatter emerging right now about the possibility of a shadow Fed. How disruption would the nomination of a new Fed chair this far out from the end of the term of the current one be for the market?
Well, look, I don't think anyone's necessarily talking about that. There will be two seats opening, or there will be one seat definitely opening in beginning of the year when board member Kruger leaves, and then the chairmanship will open up in May when Chair Powell leaves. So Chair Powell doesn't have to leave. He could stay on the board, not as chair. So there is a chance that the person who is going to become the chair could be appointed in January, which would probably mean a October-November nomination.
Your name has been floated in some media reports as a possible replacement for Fed chair come next year. Your response, is that a job you'd consider taking?
Look, I'll do what the president wants, but I think I have the best job in Washington. We're making meaningful change, working on the president's agenda every day. I get to work closely with the president. I think that, as I like to say, we've done peace deals, trade deals, and tax deals. We spent the first 100 days setting the table on those. Now we're going to be landing all those over the next 100 days. So I think that's going to be pretty exciting.
All three of those we've been talking about this week. Finally, the idea, and I think this is really key, and it kind of brings us back to the beginning of this conversation with trade and tariffs, but this idea of higher inflation tied to tariffs. Case in point this morning, we haven't really seen it show up in the hard data. The Fed and Wall Street economists think that that's something that's going to materialize this summer. How are you and the administration gaming this out and thinking about this inflation dynamic?
Well, look, as you said, it hasn't played out, and we're seeing very low numbers. And forget imported inflation, because if we were to get it from tariffs, which has not happened, it doesn't have to happen. That's a small part of the inflation calculations. What we're seeing is service inflation drop. I think we're going to see the rent component drop, and the overall housing component, which is implied owners' rents, drop. So the Fed's measure of super core inflation is way down. PCE year over year is down. So it looks like the trends are quite good. We're at a 4-year low in gasoline prices, so we're going to have a great summer travel season. And Morgan, one thing I heard you talking with your colleague earlier when they talked about the April tariff panic. So we found out today, this episode from April 3rd to today is the fastest bounce back after a 15% decline in S&P history. Fastest bounce back ever. So, the administration doesn't look at the stock market every day. What we try to do is set in place economic fundamentals, and presumably the market had a chance to digest the panic and is looking forward. So, I think it is telling you that the tariff panic, or as I like to call it, tariff derangement syndrome, was overdone. We're seeing earnings growth. We're seeing a good path for interest rates. So, I think the economy is looking pretty good.
And all of that has led to stocks at record highs today. Secretary Bessent, Scott Bessent, U.S. Treasury Secretary, great to speak with you. We covered a lot there. I do hope you'll come back and join me again. Thank you so much.
Thank you.
Well, let's get some reaction to that conversation with Secretary Bessent and today's new highs. Joining me now is Morgan Stanley Wealth Management's Dan Skelly. Dan, it's great to have you on. Let's start right there. We do have stocks at record highs. We just heard a lot and covered a lot with the Treasury Secretary. Your reaction?
Thanks for having me on, Morgan. And look, yes, the market has rallied very quickly and very aggressively. But our key takeaway today is to curb your enthusiasm over the summer. And I think it's really important today to do a then and now analysis. Then at 4,900 on the S&P 2 months ago, hedge fund positioning was at a decade low. Now it's flipped to a more normal level in terms of average net exposures. Secondly, earnings in the first quarter were excellent, but they benefited in terms of the pre-buy economic environment with the top line boost, as well as no real tariff pass-through yet, because no one knows, frankly, what level of tariffs we're going to land on. And thirdly, and most importantly, the hope of negotiating tariffs and this very premise that tariffs would be negotiated was the key insight at 4,900. Now, what we're seeing clearly is the details and the execution around landing these deals is going to be different. And frankly, the risk reward around that at 6,000 is harder.
Okay. So in light of that, where would you be investing money right now, or would you be taking profits off the table?
Morgan, we would be telling folks if their plans and their longer term asset allocation has rebalanced to a point where they're now overweight or they're excessively positioned in equities, yes, it's okay to trim modestly. But we would still argue there's a ton of fundamental and structural positive themes underneath the surface. Frankly, when you look at the leadership, and Michael Santoli touched on this earlier, it's been a repeat of the 23-24 leadership in the last 2 months. And so you're seeing that technology leadership, high quality leadership, large cap leadership. And I would also double click for a moment on this whole thesis behind powering AI. We've seen the industrial complex and specifically the names and the ideas that help the AI ecosystem and infrastructure gain new highs very quickly. And that's still a theme we like.
Financials have had a very strong week and a very strong couple weeks. We're expecting these stress tests to come out here in about 10 minutes. And then, of course, we know the big banks will help kick off earnings in about 2 weeks. Is this an area to focus attention on? How much is it a harbinger for the results we will get here over the next couple of months?
Sure, Morgan, I'm glad you asked. Financials continues to be one of those higher conviction themes that we like. And that's been the case, frankly, for over 9 months. And there's a lot of different drivers to that outlook. I think one of them clearly is deregulation on the horizon. And we're going to hear, to your point, very quickly more about capital return likely going higher. Secondly, the capital markets delay that happened vis-a-vis the tariff panic, as Treasury Besson alluded to earlier, has now started to normalize a lot really quickly this quarter. We've seen IPOs and deal making pick up quite a bit. And frankly, we think following a 3-year down cycle in those end markets, there's still room to run on that front as well. And last but not least, I talked about this earlier in terms of tariff potential impacts to certain parts of the market. Banks don't suffer from that. They're mostly domestic orientation, and thus they're not going to really have a negative tariffs outlook.
Dan Skelly, thank you so much.
Thank you.
Coming up, we'll look at some of the names making the biggest moves off of the April lows. Spoiler alert, Apple's not one of them. As the Nasdaq has rallied 17% since April 1st, Apple is down 9%. As a result, the stock is getting left in the dust on the road to a $4 trillion market cap. Can Apple get back on track in the second half? We're going to discuss that. Overtime's back in 2. Welcome back to Overtime. The S&P 500 is up more than 20% since the early April lows. The biggest winner on the index since then joined halfway through. That was Coinbase, up 120% as stablecoin summer kicked off. It was added to the S&P 500 in May, so that helped as well. Next best, Seagate Technology. It has more than doubled off the lows. And it's not just tech names either. The power players are also among the top performers. NRG, Vistra, GE Vernova, Constellation, all up about 80% since April 8th. Well, meanwhile, one name that is sitting out this entire rally is Apple, falling more than 9% this quarter as some of its rivals hit all-time highs. Will Apple turn the corner in the second half? Joining us now, Gene Munster, managing partner at Deepwater Asset Management. Gene, it's great to have you on.
Hi, Morgan.
What's it going to take for Apple to rally here?
I think it's going to take optimism that the new Siri is going to crush it. And after WWDC, that was the clear message from senior management. They basically went on a media blitz to tell people, judge our AI chops on what that new Siri is going to look like. And I think that for investors getting more confidence that they're making progress towards that, that's what this year is all about. I would also mention that there's this added benefit, the fact that they've essentially reset the bar. Don't expect anything from us about AI over the next year. The fact that they've reset that bar, I think it really does lower what some of investors' expectations are for Apple and AI the next year. In other words, that low bar, I think, can be positive for the stock in the back half of the year. And I think investors are kind of processing that piece, how much room to give them. There's one other piece that rarely gets talked about, is the iPhone numbers have come down pretty dramatically over the past 6 months. If we rewind to late last year, investors were generally looking for about 6% iPhone growth this year and about 8% next year. Now it's about 1 and 4%. And so, Morgan, when I think about the opportunity for the stock, I think that this can kind of win on two phases. One is just the simple block and tackle of people coming back, buying their iPhones, doing what they do, committed to the Apple platform. I think that should bode well for Apple iPhone numbers, but also kind of some growing anticipation for that new Siri next year.
Meta's CTO Andrew Bosworth was on the show with me a week ago, and one of the things we talked about was how aggressively Meta is targeting top AI talent. Does Apple need to do the same here? Would an acquisition go a long way?
It would. Perplexity would be a home run. Essentially, it would give them not only a agentic browser to supercharge what's going on with Safari, but also give them a search product, which is pretty incredible, and the tools to build on top of these other LLMs. So, Morgan, I think it's a huge deal, a huge opportunity for Apple to add this other talent. And the bar is high, but they've got money to spend. They've only spent $10 billion on CapEx. Compare that to 30, 40, 50, 60 billion by the other hyperscalers. So they got room to spend. And I think that's one of the messages you're going to hear from Apple when they report their June quarter, is this kind of commitment to spending more. And to put quickly some perspective on that, is that that 10 billion in CapEx that they're going to spend, they spent last year, again, compares to, call it 50 billion for the rest of the hyperscalers. I think that they can move that up to kind of 25 to 50 billion, acquire that Perplexity. That would be a home run, I think, in terms of not only the fundamentals of the business, but also in terms of what it could do to investor psychology. And so I kind of think about that hiring piece. I think this Perplexity is just a really underappreciated opportunity, particularly around what they could do with search and essentially replace Google in that arrangement. That would be a really powerful opportunity in the midst of this FTC pressure around that relationship. And so there's a lot of levers Apple can play. I understand that they haven't delivered. Clearly, they haven't delivered. But if you look at all the tools, they've got time, and I think they've got the resources to really turn the tide around AI.
So mega cap tech ex Apple, we'll say, has had a very good run here. Does that continue?
I think it does. And at Deepwater, we're of the belief that ultimately that we're still in the very early stages of AI. I just want to put some quick context. I think that the mega caps are going to continue to do well. I think the real outperformance in the back half of the year is going to come from some smaller names. And if we use a benchmark, the LOUP, which is it's our Frontier Tech ETF, as a benchmark of kind of the sub $500 billion companies, just over the past 3 weeks, that's up 7%, outperforming the Mag 7, which is up 6, and the NASDAQ up 3. So Morgan, I think investors can sleep well at night owning these big companies, but also kind of think about shifting to some of these smaller cap ones that are capitalizing on what still is early stages of AI. Hard to believe, but I still think we are in the nascent phases, and I think these small companies are going to have an outsized benefit.
Okay. Gene Munster, appreciate it. Thank you.
Thank you, Morgan.
With the tech sector and the S&P trading at record highs as the S&P trades at record highs. Stocks with a huge rally from the April lows to this morning's record highs, but pulling back on the news that the U.S. is calling off trade talks with Canada. And I'm going to just go ahead and interrupt myself because we do have some breaking news. Those Fed stress tests are out, and Leslie Picker has it for us.
Hey, Morgan. Yes, all 22 banks tested remain above their capital requirements after absorbing hypothetical losses of more than $550 billion this year. The scenario by which the banks were tested against was widely seen as more moderate, evidenced by the aggregate decline in the Common Equity Tier 1 capital ratio of 1.8%, the lowest decline in years. The 2024 results, by comparison, showed hypothetical aggregate declines of 2.8%. This is the first round of stress tests with Michelle Bowman in the vice chair for supervision seat, although the test was developed before she took that role. Under this new regime, though, there's been a broad expectation of loosening capital requirements and regulatory reform. Just this week, the Fed proposed an easing of another leverage rule. Bank stocks are up about 4% over the last week on optimism surrounding capital. As for today's results, though, Vice Chair Bowman said in the statement that, quote, one way to address the excessive volatility in stress test results and corresponding capital requirements is for the board to finalize the proposal that would average 2 consecutive years of stress test results, which was released in April. Fed officials said that the better results this year were driven in part by the way the test was designed, as well as the strong recent performance from the banks. The hypothetical losses included $158 billion in credit card losses and $124 billion in commercial and industrial loans. On Tuesday, the banks are expected to each provide details on how the results of this test impact their plans for buybacks and dividends. Morgan.
All right, Leslie Picker, thank you. Well, joining me now is Gerard Cassidy, co-head of Global Financials Research at RBC Capital Markets. And Gerard, your takeaway from those results we just got from Leslie, especially since we have 2 full working days until we start to hear about capital returns to shareholders. I think we might be having some technical difficulties with Gerard. We're going to go to a quick commercial break, and we will pick this discussion up on the other side of it. We'll be right back.